Welcome to the Growth Whisperers, Growth Whisperers podcast, where everything we talk about is about building enduring great companies. Because that's kind of what turns our crank. We like it. We get excited about companies that build value over decades, generations, whatever it happens to be. And so we study and work on with our clients every day. I'm Kevin Lawrence in Vancouver, British Columbia, Canada. And I'm here with my co-host, Brad Giles in Perth, Australia. Brad, how's it going today?
It's pretty good. I am turning my crank on enduring great companies, as you put it.
That's good.
Going well on this Christmas Day. I think this episode's coming out.
It is Christmas Day. This one's launching. We're not recording it on Christmas Day. We're with our family. So for all those of you that celebrate Christmas, we wish you a Merry Christmas. And for those who don't, happy holidays. And whatever you celebrate, I hope you're having a great day today, whether you're working or with your family, whatever it happens to be. And maybe you're doing both. I don't know, but hopefully you're having a wonderful day. So, Brad, what's your kind of word, phrase, or thought of the day?
Well, it's family.
I'm wondering what it's family. Okay,
it's family because certainly in our household, in our culture, the holiday that is the 25th of December is really a chance to stop to enjoy a meal or a few meals with a family. And just slow down and look at things through perhaps a slower perspective. So yeah. It's family.
Yeah, and I would tie into that connection and just, quality times with people you care about. Everyone's frantically running around, and in our culture, and people come together on the 24th and 25th in particular with families and spend time together and tell stories and laugh and whatever rituals that they have in their family, and just come together and have a great time and get reconnected. People travel all over the world to get back, for the 24th and 25th. And then we have, Boxing Day, where many go shopping, and, others have lots of as a day for a lot of parties and things like that with friends. But it's great time to connect and get regrounded in those people that help to bring out the best in us, and whether it's our parents or our siblings or kids, whatever. It's special time. So wonderful.
Yeah, for us it's very much about the beach, believe it or not. Summer, the beach, Christmas holidays is it's there's a lot of
never
beach time.
Thought about that. That's right, because it's your summer. For us it's winter, and it's about a great Christmas day is when it snows.
Oh,
like we always hope for a bit of snow on Christmas, and not so much that the relatives have a hard time getting around, but enough that it looks, and having a white Christmas because it looks beautiful. I guess that probably doesn't happen for you. You probably don't even have that concept down there, do you?
Not at all whatsoever. No, the idea of Christmas that where it's snowing is only on American television. That's it. Yeah, we don't even know what it means. Yeah.
Well, I would tell you, I could handle a little bit of snow. A sunny Christmas would be nice. All right, well, let's jump into today's show. So, we're talking, we're on episode 3 of 5 in this 5-part series about planning to win in 2023. We had an overview, which was the first one. The last one last week was around people and how do we really think and optimize when it comes to our people. And today it's around strategy. And, when it's really, in a downturn that we're potentially heading into, and we hope not, but the arrows are pointing in that direction. Customers might need different things, or they might need a different version of the same things, and spending might change and it might not, but we need to have our eyes wide open. And, in the quote I shared last week from Art of War from Sun Tzu is about victorious warriors win first, then going to war, which is really thinking ahead and planning. And it's kind of the road we want to walk you down a bit today. And so that's where we're kind of going, is how can you, when it comes to the strategy window that you look at your business through, how can you spend a bit extra time to be a bit extra prepared and be on your toes so that you're not surprised and having some undesirable or shocking surprises and being caught, maybe a little bit asleep.
I think that's really good. Like, we've got a plan. We know the importance of planning, right? But equally, I come back to a quote that our good friend Jim Collins said, that is, the signature of inconsistency is not unwillingness to change. The signature of mediocrity is chronic inconsistency. And so what we're saying is, like, many companies broadly have a strategy. How are you going to be different? How are you going to create a unique and valuable position in the market that is different from competitors? And we may need to adapt given this environment, but we've got to keep the fundamentals in place. Pivoting is fine for startups where they haven't been able to get product market fit, but pivoting is not something that a business that is enduring and lasting should be doing.
Yeah. Over pivoting is a problem.
Yeah.
And some people get too caught up. By the way, Brad, let's just tweak that quote, because when you said it, it didn't land. So I just looked. The signature of mediocrity is not the unwillingness to change. The signature of mediocrity is chronic inconsistency.
Thank you.
The first word, the first phrase was mediocrity, and I was listening to it, and I was like, I had to clarify it. So
no, thank you.
It's mediocrity is often changing too much and not being consistent and grinding out the things that matter most. And that's it's another quote from Jim is, it's success is the relentless execution of the boring basics in your hedgehog, right? The boring basics that matter absolutely most. So we're going to dig into some more of that stuff today. The first thing I wanted to talk with, example, is that, I was with a CEO 2 weeks ago, and I've been working on this 4 forces of growth stuff for my new book. And I was testing some assessments, but no matter what, we had them figure out that they were spending about 10% of their time in the growth quadrant and 60% at least, or 70 in the improvement quadrant. And we could have a whole conversation about why they were in the improvement quadrant. What is it to do with their team or their folk? But the reality is, what they realized based on their growth goals, they probably need 60% of their time focused on the growth of the company. And that's, sales, marketing, mergers and acquisitions. They don't want to merge. New markets, but they got a gap of 50%. They're distracted with a whole bunch of other things. Said differently, the pilot needs to be in the cockpit actively flying the plane, not messing around in the back and dealing with the baggage or dealing with the customers. But they were way off, and they had the epiphany, and they really have to reallocate their team. So the thing to really share is, the key with strategy, you need to be focused on, every business is different, but what is where around growth or the opportunity part of your business, and not too much time spending problems or dealing with those other issues, because you're going to have to work harder to get the same growth. And this other CEO said, different CEO was like, I've realized he spends, 30-40% of his time in a growth quadrant. And he realized he probably needs to spend 60. And I said, well, why 60? He goes, well, because it's going to be twice as hard to grow as it has been in the past. So if I want the same growth rate, I probably need to do quite twice the work on growth to get the same growth rate I've had in the past. I was like, yeah, it's brilliant. Point of it is spending your time where it matters and where it's going to drive your business, which will be different than it probably was the last couple of years.
So for our listeners who have a belly full of turkey and are thinking, what are these quadrants and the 4 forces? So we did an episode, I think it was episode 137, the 4 forces of growth. And this is the model that Kevin's working on for his new book about the 4 forces of growth. So you can go back and have a look at that. But it's a great point, Kevin. We need to be consistent with what we're working on and understanding.
And we're spending our time. Yep.
Yeah. So maybe we kind of begin as well by asking about your hedgehog, looking to the uncertainty that is 2023. Let's go back to the hedgehog, which is from Jim Collins, and it asks 3 questions. What's your core purpose? What are you deeply passionate about? What's your economic engine driver? How do you make money? And then Number three is what can you be the best in the world at? And so at the intersection of those three circles is the hedgehog concept. And that is the discipline that we maintain as we climb the mountain that is our BHAG. So in the uncertain times, we need to maintain that discipline also.
Yes. And that's a great to go back to those core principles that you've looked at and worked on over the years to get reground. And if you don't have those guiding principles, maybe sort them out pretty quick.
Because they are the guardrails as you're racing up this mountain, like that. We should revert back to these fundamentals, and that is, the basis of strategy is understanding these broad decisions that we make. We've got to stick in the middle.
Who are we? Who aren't we? How do we win? How do we not win? All that stuff. Awesome.
So it reminds me of a client who was heavily reliant on government spending. They were always, they serviced that market and they did it well, but the problem, they were concentrated in one area. And whilst it wasn't the going into the down market that we're talking about, in their world, it was a down market because a new government came in, and that means that the new government had new priorities, and they stopped spending everywhere that they didn't really, wasn't essential, let's say. And so suddenly their revenues just plummeted. And so understanding how does the strategy cater for those types of scenarios and being prepared for that means that you don't have to make terrible and difficult choices if that happens when it's too late. And to your Sun Tzu quote from the beginning, that they're going to war with a plan.
Yeah, and and lots of governments are spending money like it's going out of style. But if things tighten up in the economy, many sectors, some countries will tighten up spending. Some will keep printing money, and that's a whole different strategy. Yeah, that's another thing to be careful of is your customer concentration and how you set up based on where the market could go in the different scenarios.
Yeah.
Another principle I think is a client that we have, and we did this during COVID. We also did it back in 09, 10, and it's just getting out front. All people getting closer to the customer. And I call it stop playing office. When times are booming, people can spend a lot of time in their office and tweak things and manage things because there's so much demand. But it's dangerous to spend too much time in your office. And some people say they can't get out. Well, that's a whole other conversation. But basically, many companies, and back then, and COVID, time for the number of times that the executives get out talking to customers, meeting prospective customers. So one, they're supporting the efforts out front to generate the opportunities, but two, they're learning and hearing what the customer's saying and wanting. And you don't get that being in the office. You don't get that through reports. So basically get them back out front so they can learn and understand a heck of a lot more. And go ahead, Brad.
And I talk about that as the ambassador role. In the book Made to Thrive, the 5 roles of a CEO. Number 2 is the ambassador role. You've got to be out there if you're the leader or a leader, and you've got to be understanding what's happening, communicating with clients regularly, so that clients and employees and others. But it's a key role that you cannot forget, and you certainly can't forget because you're worried about what's happening. You've got to be out there knowing what's going on.
Correct. And it's easy to get bad habits in booming economies. Yes. It's interesting. Another company I worked with in the US, they had 2 company planes. And they were amazing. They had this discipline nailed, but they had 2 planes so that they could go and see 3 and 4 customers a day. And they had big customers they did a lot of volume with, and they would take 4 or 5 members of the exec team and hit 4 customers. And those, each of those customers would do tens of millions of dollars of business with them. And they would go and stop and see them regularly, which allowed them to keep their relationships, keep in front, and they show up with their freaking executive team when they're working on deals, right? Not the salesperson, not the head of sales, the head of sales and the executive team which means like we're here to do business, like seriously here to do business. Now that was their strategy, and it worked incredibly well for them. And it's not about getting a plane or planes, but it's about regularly being out in front of your customers, because it shows commitment, show of force, show of how important a customer is.
An effective strategy should organically drive customers to your business because you're meeting their needs better than any other competitor. It's all about the customers and meeting their needs. And sometimes in these environments, whilst we maintain, okay, we don't want chronic inconsistency, we may need to adapt and understand. So going back and thinking about your core customers and what are their needs, and are their needs changing in this new 2023 potential recession environment? Is their spending perhaps changing? Could actually create opportunities as well as some challenges, and actually taking the time to understand in this new environment, what do we need to do? How do we maintain the integrity of our hedgehog and what we understand to be our strategy moving forward?
Yeah, and having the humility just to go be listening and asking and understanding. And the customers will be talking. One CEO says, every time I go out, I find way more opportunities than we can probably handle. But they said they don't get enough. I'll show you a story what not to do. And this was a story I remember very clearly in the economic downturn. And this was a company that I worked with. I'm going to be generic out of respect for the company, but they were booming. They had the highest EBITDA percentage they'd ever had. And it was just a cash cow, a money machine. And, they had a strategy that was very clear. Major national brands, and they were had all of the same products and the same features and benefits, but they were like a lesser known name. But the product was essentially the same, but not from a national brand. Think of it being, like a knockoff of Apple.
Yep.
Right? It's not as extreme because they weren't in electronics. But I'll give you an example. And if the Apple had all the features you wanted, it was $1,500. They would have all the same features. It wasn't software dependent, so it wasn't as challenging to convert. And they would have been $1,200 instead of $1,500 with all the features, all the stuff, looks the same, just a different brand on it. So that was their strategy. And they done very, very well. Business was booming, going through the roof, everything. And then when the market changed in 2008-09, they got hammered hard, like really badly.
As in they lost sales?
Yeah, a lot of sales, more than they should have. They dropped more than the market dropped. And what happened is these big national brands obviously got more competitive, but they found when they actually went into the market, they no longer had any differentiation in competitive. They basically, their strategy wasn't at play. See, what happened is the market was so booming. Well, they were selling their iPhone, their no-name iPhone, for $1,500, and the iPhone was $1,500. So they were right there. If the iPhone was $1,500 with all the features, they had all those features. They were supposed to be $1,200 to have a value difference. But they were actually at the same price. And the price had creeped up, not because of the strategy, because there was so much demand in the market, it didn't matter. And what they didn't realize is they'd given up their competitive advantage, but then all of their designs and their supply, everything was designed around a $1,500 unit. They had lost their way on being a cheaper alternative. And it's sad because it really hurt the business. Took a long time, took out all their profits. Thankfully, they'd stacked some cash in the times that it was good, but these were good people, smart people. But during the boom, the CEO took his eye off strategy and they were full-blown execution mode. And basically they drove away their own competitive advantage. They let it go. And when the market changed, their competitive advantage was so weak that it really hurt.
Maybe we'll talk about this when we get to the execution section and we're looking through our eyes, trying to seek discounts from our suppliers, okay, get better prices. But in this environment, it might be worth considering discounting. So what are we going to do if customers ask us to discount? Now, I've got my opinion on discounting. Do you think we should be discounting, Kev, if we're given the opportunity to win some more work in a downturn?
No.
I agree. No. Why?
Any undisciplined person can lower price to get a sale. That doesn't take any skill. It doesn't. Now, there's negotiating terms and salespeople do all the time. But, changing your strategy and starting to discount is a dangerous way to go. So I'll give you an example from the car world. I'm a car nut. Brands like Porsche, I know for sure, and I believe Ferrari, when demand drops, they make less units. So they don't have to discount at all. Zero. So they modulate demand. American car makers in the past, like the GMs and the Fords, they don't modulate production near as much. So when the market slows down, they have to discount like crazy. 10,000 off, 20,000 off, $25,000 off, So it's a different strategy. And if you want to preserve the value, particularly brand and things like that, you want to discount it all. You want to avoid discounting at all costs. Just constrain your supply. Maybe don't produce as much for a period of time. The only way it makes sense to discount if there's a way that you can discount and increase your profitability. Right? Some people will go chase margin dollars and say, well, instead of doing a $20 million contract with $12 million of margin, we'll do a $30 million contract with $12 million margin. That's just not smart. I mean, sometimes, look, you got to do things sometimes, and sometimes you have no choice, right? You've got fixed assets that you got to cover with some volume and things like that. But generally, that should be the very, very last option, and it's an undisciplined way sometimes, and sometimes maybe it's a strategy. I mean, if you're a discount brand, it's different. I'm talking if you're not a discount brand. So there should be a lot of other levers that you can pull first. But it's the one your salespeople will come back with real quick and say you got to do.
Because we need to make the gross profit budget so that we can pay expenses. That's what they're going to say.
Well, actually, they're going to say we're going to need to do it so we can get our bonuses or hit our sales targets or get our commissions.
Yeah,
they often don't care about the inner working. So, and they're not bad people. I don't blame them. But the reality is discounting is usually that means you've got a lack of a strategic alternative. And but yeah, you might, and maybe your industry gets more aggressive on pricing, but it should be. And I just read this great quote about discounting, and who was it in the last week? I know. So for example, one of the clients that I worked with, and I'm trying to recall who it was. There's so many great examples. But one of the things I know, and the thing is, once you start, in retail, for example, once you start going on sale all the time, and you train your customers to expect discounts, it takes years to then train them to wait and pay full price.
Yeah.
Because people start discount hunting all the time. So anyway, sometimes people have to do it, and it's part of what they do. I think that just means you need to get more creative and find ways to do it. So if you can discount and increase your margins and change the structure of the deal some way, or you can discount and increase your net profit from it or your EBITDA from it from other creative ways.
Yep.
Fine. But that's, discounting the top line in a way that might benefit somebody else, but making sure that more sticks for you. That would be the discipline trying to stick to if at all possible.
Well, if we overlay the strategy lens onto what we're saying here, we want to avoid the industry standard price, okay, at all costs.
Yes.
Because with the industry standard price, all we're doing is collecting the inputs of costs of labor and materials and real estate and whatever else, and then we're just ending up at the average price to produce a theoretical average 10%, or whatever percent. But strategy tells us that we've either got to charge more than that by providing more value in the way of additional options, service, what have you, or we've got to provide more value by having a more efficient supply chain and efficient delivery method. So we're either providing more value above the average price or below. And so putting that back to discounting, either we're saying, or what we're saying is, if you can provide more value through that discounting, then that's fine. And you may be able to actually discount by adding something into a deal in these tough times.
Yes, there's lots of things. And the point of it, I think, Brad, as you're getting to is to put that creative energy onto how do we add more value?
Yes.
That's it. Like, how do we add? So I've got one of my clients, and we were just taking a look back. And when we started working together, their gross margin was 22%, right? Which is typical for their industry. But we also found that the best was getting close to 40%. Not the average, they were at the average, but the best was 40. So we started hunting down 40% margins, and it took a few years. We got the whole company up to 32, 10 points higher, most of which is sticking to the bottom lines. They have a much healthier bottom line. But the point of it is we started hunting it, and we started thinking dramatically different, not linearly and logically, but strategically, looking for value that we could create and creative things that we could do to charge more and or have a notably lower cost base and crank up the margins, which we did successfully. But it's because we put, and I have many examples of that. And it's not about the economy. It's looking for problems you can solve that people are willing to pay more for, or packaging it in ways that make it more attractive for them because they have different needs. Yeah. It's a very, very good point.
Yeah. So where are we going with this? If we look at it, what we're saying, tough environment in 23, we're looking at it through the lens of strategy, which is about creating a unique and valuable position relative to the competition. And then we kind of come back and say, we've got to maintain consistency. We're looking at the hedgehog around that. We're trying to then say, it comes down to the plan. So you've got to be able to look at what your plan is delivering. Is your plan going to be less effective, i.e., you're going to be not able to meet those customers' needs? I saw a great quote from Jeff Bezos recently, and it's really interesting because it makes you zoom right out. It says, I very frequently get the question, what's going to change in the next 10 years? I almost never get the question, what's not going to change in the next 10 years? And I submit to you that the second question is more important of the two, because you can build a business strategy around the things that are stable in time. So without going through that in great detail, like, that's a really important point. Is your strategy something that won't change through this potential downturn?
Yeah, and what pieces of it for sure won't change. And there might be some that you wonder about, but some of the fundamentals, Collins calls it the relentless execution of the boring basics. What are those boring basics you got to master? Because they're not going to change. What the customer wants is going to be the same.
And to that point, very quickly, Jeff Bezos goes on and he says, I can't imagine a future where people aren't going to say, I wish that prices were a little higher, or I wish you could deliver a little bit more slowly. So what are the other fundamentals of your strategy, the difference between you and the competition, and are they everlasting?
So the other thing really quick, and then we'll wrap up, but getting into that thing about profitability, also at the root of it, the whole thing is you got to know where you make money and where you don't, and be creative about opportunities. And a lot of people don't have great granular profitability reporting. Part of this 4 forces of growth, we built an assessment in behind, and on the capital side, there's a big piece on reporting. Most people's reporting is very high level in general, and they don't know the most popular profitable customers. They know the gross margin maybe, but not profitability per customer, not profitability per product or per region. And in the companies that we dial in reporting, you know exactly what's what. Where is the profit made? Where is it given back because of customers that you don't make money on? So getting that profitability, and then you can make conversations. Interesting. I had one client that had a customer that was about 25 million a year of volume, and they came and they wanted further discounts. They demanded it in a tough time. Well, thankfully, we had profitability per customer data, which we'd reviewed. Well, we made 250 grand a year profit after everything was allocated, because they were a high maintenance, low margin client. And basically, in the meeting, I go, tell them to pound sand. That's a nice way to say some bad words, in our culture.
To go away?
Yeah.
Tell them to go away?
Like, tell them to, no. Again, I was able to say that I wasn't making the decision, but I knew if we're making 250 grand on a $25 million customer, I'm not even entertaining the conversation of a further discount. It's no, actually, we should increase your price.
Yeah.
But the thing is, we had the data to know not to even waste any time on it. And that's the key. Right. And obviously, and there was no way to really, there wasn't a lot, for a lot of reasons, to really increase the margin of the profitability on that customer. But it's understanding that. And then you can make a bunch of the.
That's the kind of gift that you can give your competitors in a down market.
Yes. Go make yourself real busy with this client that you barely make 1% on. Is that 1%? I think it's 1%. Yeah, it's horrific. Or less than 1%. 25. 2.5.
It's not much.
Yeah.
It's
1%. 1%. Yeah. And if you put a cost of capital on that, no. Anyway. So the idea here is really evaluate your strategy and look about where you're making money, where you're allocating resources and your focus. I mean, having, in that last piece I talked about, return on capital, and we'll talk about that in the profitability section of the capital section, but knowing, where you make money based on where you invest money is also a helpful thing to get into it. Knowing what works, out there talking to customers, feeling, touching, hearing the market, and making better decisions, and ideally avoiding discounting unless that's something that your whole industry is doing and you're forced into it.
Very good. Good conversation. And you know what? It went down a number of rabbit holes, which I enjoyed. I hope that you did as well. So
it's fun.
Yeah, look, it is. That's why we do this. We've got other things to do on Christmas. We're not really here on Christmas Day. So yeah, how do you win in strategy? I guess you begin by being consistent, understanding the needs of the customers, all the things that we've covered off without going back to them. Now, next week, we're going to be talking about how to win in strategy, how to win in 2023, on execution. So look forward to that one. Some interesting, because look, execution is how you retain the profit, which matters so much. So let's move to close. My name is Brad Giles. This is the Growth Whisperers. My colleague you've been hearing chat is Kevin Lawrence in Vancouver in Canada. I'm in Perth, Australia. As you may be able to pick up by the difference in the accents that we have. You can find both of us. We put out an interesting newsletter each week. If you enjoy this subject matter, you can find mine at evolutionpartners.com.au. You can find Kevin's at lawrenceandco.com. And obviously, also, you can find us, if you prefer to see our smiling faces, on YouTube, just by searching The Growth Whisperers. Hope you've enjoyed the show. Look forward to, and I hope that you've actually had a good Christmas, holiday, whatever you celebrate, a bit of a time off, bit of a break. Hope you've enjoyed the day. Look forward to speaking to you again next week. Enjoy your week.
Have a good one.